Hello everybody, it's Yashar here, back again with another video, and in this video I'm going to talk about my own stocks portfolio and update you on my positions and a few major changes to this portfolio during the last 2 weeks. This video would be a little bit different from my usual portfolio update videos, as I want to explain why I sold some of my stocks and bought the dip on other stocks. So instead of showing you the returns and go over each of the positions like previous videos, here I want to explain the reasoning of this basically move. Okay, let's jump right into this. We consolidated our positions in the last 2 weeks. 2 weeks ago, we had 12 companies in our stocks portfolio, 4 US companies and 8 Canadian companies. You see the list of our old holdings in this picture. I sold 3 of my stocks during the last 2 weeks and reinvested all that money into our other positions. So now, instead of 12, our money is invested in only 9 companies. I will start with the companies that I sold my position in them. So these 3 companies were our smallest position in the portfolio. In my RRSP, I sold PayPal and Amazon. Amazon at around 5% profit and PayPal at around 14% profit. The reason I sold these 2 stocks was not because I don't believe in them anymore. No, it was simply because they were a small position, they were in green, and I could see a better investment opportunity at this moment in time in the market for my money. I sold 11 shares of PayPal at $19.8 per share and 4 shares of Amazon at $116 and reinvested all that cash into one stock, which is Google. I bought 15 more shares of Google in my RRSP, so now the total number of Google shares in my RRSP is increased to 25, while I'm still holding my 50 Google shares in my TFSA. So overall, I have 75 shares of Google right now. I believe Google has an amazing risk-reward profile at this point in time. It is a great business, has a huge moat in data and AI, search engine, entertainment, and advertising business, and their valuation is a screaming buy at this point for me. All the valuation and quality matrix of Google says it is undervalued at the moment. Its price to earnings, price to cash flow, price to book is lower than its 5-year average. Its PEG ratio is close to 1. The return on invested capital and return on assets remained strong in the last year, even stronger than the last 5 years. And my calculation and estimates based on discounted future earnings model tells me the fair value of Google stock for 10% return year over year in the next 10 years should be around $125 per share. So the shares of Google today are at 25% discount according to my estimates. Comparing to PayPal and Amazon, I believe Google has a better valuation at this time, and that's why I consolidated those 2 stocks and put all that money into my Google position. The next stock that I completely sold it in the last 2 weeks was Power Corporation of Canada inside my TFSA. Again, I still like Power Corporation as a company, but there was one simple reason why I sold this stock. I saw a better opportunity for my money at this point in time and rebalanced the portfolio accordingly. So Power Corporation held up pretty well during this downturn in the markets and was only down around 12% for me when I sold it. While the other companies like EQ Bank and Brookfield are more undervalued at this point, in my opinion, EQ Bank and Brookfield in similar time frame were down 24 to 26% for me. So I sold my 100 shares of Power Corporation and I bought 50 shares of EQ Bank and 20 shares of Brookfield instead. I strongly believe that EQ Bank and Brookfield offer extremely good value here. According to my calculation, all the valuation matrix says that EQ Bank is undervalued by a large margin here. Their PEG ratio is close to 0.6, their PE and price to earning and price to book ratio are lower than their 5-year average, and my discounted future earnings model tells me that the fair value of EQ Bank for 10% return year over year in the next 10 years is close to $69, and it is around $47 today, which means the shares of EQ Bank are traded at around 45% discount today. The same exact thing is going on with Brookfield. Their PE ratio is almost 50% lower than the 5-year average. Their price to cash flow and price to book ratios are significantly lower than the 5-year average. The PEG ratio for BAM is around 0.9, and discounted cash flow estimates the fair value of Brookfield in the next 10 years for 10% return year over year is around $74, when the current share price is around $54, which means Brookfield shares are traded at almost 35% discount at this time. That's why I preferred to sell Power Corporation and buy EQ Bank and Brookfield with that money. I also deposited a little bit cash and bought 15 shares of Bank of Nova Scotia, 7 shares of Granite REIT, and 9 shares of Killam REIT to lower my average cost on these positions too. I now have 150 shares of EQ Bank, 120 shares of Brookfield, 90 shares of Bank of Nova Scotia, and 60 shares of Granite REIT. My wife also doubled down on Meta, and now we own 50 shares of Meta platforms together. This is the new consolidated portfolio, as you can see it here. Aritzia is still continue to be the largest holding of our portfolio, followed by Google and Meta. I will continue to update you on my positions and the performance of this portfolio, and also will cover the earnings report of these companies in the coming weeks. There you are, guys. I hope you enjoyed the video and my transparency in showing you all the positions I have in my portfolio and also the performance of our stocks. If you enjoyed the video, consider subscribing to the channel to see similar videos. Thank you for watching, and I hope to see you guys in the next video. Farewell.